Welcome to your weekly market update where we talk about everything mortgage and real estate related. We have some great information to talk about as always, so let's jump right in it. First off, we're going to talk about pending home sales, which measures signed contracts on existing homes. They rose 0.9% in July, which was stronger than estimates of a 0.6% drop. Despite the media's best efforts to put a negative spin on this report, this was the second increase in a row that we have seen and shows a lot of strength, considering that rates were around 7.5% and inventory was down 15% year over year. Sales are still down 13.8% year over year, which lines up closely with the decline in inventory, is not due to a lack of demand, but just the lack of supply of housing. Now, as for housing prices, Case-Shiller Home Price Index, which is the gold standard for appreciation, showed that home prices rose 0.6% in June. Now, home prices have been on the rise since January and are now flat from last June. And remember that last June was the peak in home prices within this report, meaning that home values have risen back to the highest levels on record and will likely eclipse them in July's report. Chicago is leading the way in home price gains this year, which are up almost 5% for the year. HFFA released their home price index, which measures home price appreciation on single-family homes with conforming loan amounts. That report showed that home prices rose 0.3% in June and are up 3% year over year. FHFA is on pace for a 7% appreciation for the full year of 2023, which is very strong. Inventory is still tight with 3.5 months supply of homes, but if you look at the active listings, about half that number. 74% of homes are sold in less than 30 days. It's a tight market, as you all know. As for mortgages and inflation, this week is jobs week, and on Friday, we will get the BLS jobs report for August. Today, the ADP report showed that there were 177,000 jobs created, which was weaker than the 200,000 expected. The JOLTS report, which shows job openings in July, this index over the last 2 months fell from 9.5 million to 8.8 million, which is a huge drop from the lowest level we've seen in 2.5 years. This is bond friendly and can lead to lower jobs figures in Friday's report. We are starting to see real weakness in the job market, which is what the Federal Reserve is looking for to stop pressing forward with tightening monetary policy, which ends up equaling to higher rates. Inflation has continued to come down, but still above the Fed's long-running rate, a goal of 2%. The weakness in the job numbers should help with inflation moving forward. This will be good for interest rates. The MBA released their mortgage application data last week, showing that purchase applications rose 2% from last week and are still down 27% year over year. Interest rates were little changed last week and around 7.25% on average. They come down a little bit to start this week, which is good news, and let's hope that continues for the rest of the week, so that way we can see interest rates continue to come down. Now, something I did want to talk about when it comes to interest rates, we do have a temporary buy down program that I would love to talk to you about. If you have any questions, you can give me a call. This will help buy down your rate temporarily. You can do a 3-2-1 buy down, a 2-1 buy down, or a 1-year buy down, which will buy down that interest rate temporarily from anywhere between 3% to 1%. Would love to talk to you about that. Give me a call at 847-942-1497. It's a great way to lower your rate temporarily, and then obviously we'll refinance you when rates drop in the near future. Thanks so much, and talk to you soon.